Should you consolidate your student loans? You've probably seen 10 different answers to that question already, and most of them are trying to sell you something. This video is the honest answer, without an agenda attached. Quick disclaimer before we start. This video is for general educational purposes only and is not financial or legal advice. Loan terms, programs, and eligibility rules change over time. Always confirm current details directly with your loan servicer or at studentaid.gov before making any decision about your own loans. Here's the honest truth right up front. Consolidation is not universally good, and it is not universally bad. It is a tool, and like any tool, whether it helps you depends entirely on your specific situation. Anyone telling you it's always the right move, or always a trap, is oversimplifying something that genuinely depends on your numbers. It helps to understand why there's so much conflicting advice out there in the first place. Private lenders advertise consolidation heavily because refinancing your loans with them is how they make money, so their marketing naturally leans toward, yes, always. Meanwhile, some financial commentators lean hard into the trap framing because a scary headline gets more clicks than a nuanced answer. Neither side is lying exactly, but neither side is giving you the full picture either, because the honest answer genuinely depends on details specific to your loans, not on a one-size-fits-all rule. So let's walk through the real decision, one factor at a time, starting with the most important question. What type of loans do you actually have? If you have federal loans, and there's any chance you'll want income-driven repayment, public service loan forgiveness, or federal hardship protections down the road, converting those loans into a private loan through refinancing is usually not worth it. That conversion is permanent. Once a federal loan becomes private, you cannot undo it, and every protection attached to it disappears with it. If your loans are already private, or you're certain you'll never need federal protections, the calculation changes completely, and consolidation becomes a much more straightforward numbers question. The second question. What are you actually trying to achieve? People consolidate for different reasons, and the right answer depends on which one applies to you. If your goal is a lower monthly payment because your current payments feel unmanageable, an income-driven repayment plan on your federal loans might solve that without any consolidation at all. If your goal is a lower interest rate to save money over time, that's a private refinancing question, and it only makes sense if a new lender actually offers you a lower rate than what you have now. If your goal is simply fewer separate payments to keep track of, consolidation can genuinely help with that, but it's worth knowing that convenience alone doesn't automatically translate into savings. It also helps to notice the emotional pull toward consolidation, separate from the financial math entirely. Carrying several loans with different due dates and different services can feel genuinely stressful, and the promise of one simple payment is appealing for that reason alone, even before you look at a single number. That feeling is valid, but it's worth separating from the financial decision itself. A calendar reminder or an autopay setup on multiple loans can solve the stress of tracking due dates without touching your loan terms at all. Save the bigger decision, whether to actually combine or refinance, for the numbers, not the stress. The third question, and this one gets skipped constantly. What does your credit score look like right now, compared to when you originally took out your loans? If your credit has improved significantly since school, whether from years of on-time payments or a stronger income, you may genuinely qualify for a lower interest rate today than you did back then. In that case, refinancing private loans can save you real money. If your credit hasn't changed much, or has gotten worse, a refinance offer may not actually beat what you already have, no matter how convenient it sounds. Let's talk about when consolidation is genuinely the right call. Picture someone with several private loans from different lenders, each with a different due date and a different login to keep track of. Their credit score has climbed since graduation. A new lender offers a lower fixed rate than any of their current loans. In that scenario, refinancing into one loan is a clear win. Lower cost, simpler payments, no protections lost, because there weren't federal protections to lose in the first place. Now let's talk about when it's genuinely the wrong call. Picture someone with federal loans, working toward public service loan forgiveness, already a few years into qualifying payments. A private lender offers to consolidate everything at a slightly lower rate. Taking that offer means giving up forgiveness eligibility entirely, and restarting from zero on a private loan with no forgiveness path at all. Even a lower rate doesn't come close to making up for a forgiven balance that could have wiped out the debt completely. Here's a third scenario worth knowing, because it comes up more than people expect. Someone has a mix of both federal and private loans, and gets a single offer to combine everything together into one private loan. This is where the most expensive mistakes happen, because it treats two completely different categories of debt as if they were the same thing. The federal portion loses its protections permanently, while the private portion may or may not actually get a better rate. Mixed loans almost always need to be handled as two separate decisions, not one combined one. Here's a fourth scenario, and it's one that's easy to overlook. Someone has a regular income, maybe they're self-employed or work on commission, and their earnings swing significantly month to month. For this person, the flexibility of federal loans, the ability to switch repayment plans as income changes, or pause payments during a genuinely lean month, can be worth more than any interest rate savings a private refinance might offer. Locking into a fixed private loan payment removes that flexibility entirely, which matters a lot more for someone whose income isn't steady than for someone with a predictable paycheck. One final scenario worth walking through. Someone is planning a major life change in the next year or two, maybe going back to school, changing careers, or starting a family, and their income situation is likely to shift either up or down during that window. For this person, locking into a fixed private refinance right now means committing to a payment based on today's income, with no built-in way to adjust if things change. Staying on federal loans, or at minimum waiting until after that transition settles, preserves the option to switch repayment plans if the new reality calls for it. The lesson across all of these scenarios is the same. The right decision depends on what's actually going on in your life, not just on the interest rate sitting in front of you. So here's a simple framework you can actually use. Start by listing every loan you have and marking each one federal or private. For any federal loans, ask yourself honestly whether you might ever want income-driven repayment or forgiveness. If the answer is yes, or even maybe, keep those loans federal, and look at a direct consolidation loan through the Department of Education if you want to simplify them without losing protections. For any private loans, check your current rate, then get quotes from a few lenders. If a new rate is clearly lower, refinancing makes sense. If it isn't, there's no rush. Let's turn that into an actual checklist you can run through with your own numbers in front of you. First, pull up every loan balance and rate at studentaid.gov and from your private lenders. Second, write down which loans are federal and which are private, side by side. Third, for federal loans, note whether you're currently on, or might want, an income-driven plan or forgiveness track. Fourth, for private loans, get at least 2 refinance quotes and compare them directly against your current rate, not an advertised average. Fifth, add up what you'd actually gain, in dollars, against what you'd give up, whether that's flexibility, forgiveness eligibility, or nothing at all if your loans are already private. If what you gain clearly outweighs what you give up, move forward. If it doesn't, or if you're not sure, that uncertainty itself is useful information, and it usually means waiting is the better choice for now. One more thing worth saying honestly. Not deciding right now is also a valid choice. If you're not sure yet whether your income will change, whether you'll pursue forgiveness, or whether your credit will improve, waiting and reassessing in 6 months costs you nothing. Consolidation isn't a deadline you have to hit. It's a tool you reach for when the numbers actually support it. Before you decide, it's also worth knowing what your alternatives to consolidation actually are, since consolidation isn't the only tool available. If your monthly payment feels unmanageable on federal loans, switching to an income-driven repayment plan can lower that payment without combining anything or changing your loan type at all. If you're facing a temporary hardship, like a job loss, federal loans offer deferment or forbearance options that pause payments without the permanence of a refinance. And if your real goal is simply paying off debt faster, putting extra money directly toward your highest interest loan each month, sometimes called the avalanche method, can save more in interest than consolidating ever would, without touching your loan structure at all. Knowing these alternatives exist matters because a lot of people jump straight to consolidation as the only lever available, when the actual problem they're trying to solve, like an unaffordable payment or a temporary cash crunch, might have a simpler, less permanent fix already built into the federal loan system. If you take one thing away from this video, let it be this. The right answer for you depends on your loan types, your goals, and your actual numbers, not on whatever a single ad or a single video tells you to do. Check your loans at studentaid.gov, know your current rates, and only move forward once you can clearly say what you're gaining and what, if anything, you're giving up. For the most current information on your own loans, always check directly with your servicer, or visit studentaid.gov to confirm what protections, if any, apply to you. One last thought. Every video on this channel about consolidation, whether it's about the general process, a specific lender, or the difference between loan types, is really pointing at this same underlying idea. There isn't a universal right answer, only a right answer for your specific numbers. The goal here has never been to tell you what to do. It's been to make sure you have the actual information needed to make the call yourself, clearly and without pressure. If this helped you actually think through the decision instead of just following advice blindly, you know what to do. And if you want the specific step-by-step process once you've made your decision, that's exactly what our earlier video walks through.